we'll be focusing back on gold. So I'd like to welcome my panelists to the stage. Please come and join me in the purple chairs. Kimberly, who is CEO, President, and founder of Lahontan Gold. Coille van Alphen, who's Portfolio Manager at Equinox Partners. And Douglas Groh, who's Senior Portfolio Manager at Sprott Asset Management. So thanks for joining me, everyone. This morning was sort of, if I could summarize it, one of the lines came from James Steele at HSBC. There was very much a risk-off environment, but perhaps that was doing some really good things for precious metals. So why don't we sort of delve into that and talk about some of those dynamics, the market, and the macro, but then also the equities, of course. And Doug, I'd love to get your take. I haven't had you speak for a while. It'd be great to hear, what's your view and your view from Sprott in terms of what's going on now on the macro side that's impacting the gold market at the moment, and how inflation and rates are sort of playing into the scenario at the moment, and also this central bank buying spree as well that was mentioned a lot this morning. Thanks.
Well, whenever I'm asked that question, I always like to step back in time a little bit, about 6 months or maybe even 12 months ago, to set that stage. Last year, the gold price actually did pretty well on average. It was, I think, 1829 or so on average for the year. We started out well in the beginning of the year and had that surge with the Ukraine-Russian conflict. And then markets were concerned about inflation, interest rates rose, and the gold price gave it up in spring. And throughout the summer, we were really kind of suffering, and into September. But it was very interesting at the end of September, the attitude in the market changed. We saw the dollar peak out right around the election last year, the congressional election. And with that, gold had a real nice surge into the end of the year, into the beginning of the year. And then as we got into February, the market began to reassess that inflation response that the Fed was carrying out with interest rates. But it was very interesting that the market really responded positively to the Silicon Valley Bank crisis and the Signature Bank failure. And that put another $150 into the gold price. So that, I thought, was really important for our sector. I don't know if the equities have really fully responded, but we've stepped up in terms of the gold price from that $18, $20 type of range to now we're in the 1900, and I think that's the kind of 1900, 2000 where we can anticipate gold prices would play for a while. And why is that? Not just the banking crisis, but I think in the last 2 years we've seen kind of an underlying theme about deglobalization and de-dollarization. And that, I think, is a very important dynamic that's going to be playing out for the rest of this decade, which is very supportive of gold. The financial media does not give this enough attention, the kind of attention it deserves. We are facing, I think, in time, a weaker U.S. dollar. The dollar will have a prominent role in trade, but clearly, from your question about central banks, they're trying to diversify their reserves away from the U.S. dollar, and thus we're seeing, strong demand from central banks. I'm a little surprised we're not seeing more demand from the retail market, but they seem to be caught up with the tech sector and what's going on there. So, I think the stage is really quite well set for the gold price to do well this year and throughout the next 2 years into 2025. My type of price projection is that we have support at $1,800 an ounce. 2,070, which was the prior high, is within reach. We're going to break out of that. I think we go into a whole new realm of trading where in time, in the next 2 years, we see 2,000 as the floor. The upside, I think, can be 3,000.
Right. And
I don't think that's so outrageous if you consider in 1980, the gold price peaked at $850. On an inflation-adjusted basis, gold prices should be about $2,800 relative to that. So,
right.
And I think investors are kind of recognizing that. At Sprott, we do a lot of business in physical, and we're seeing very strong demand for physical. Years ago, we would talk about the merits of investing in precious metals, and it was a matter of educating investors about the opportunity in precious metals or fiscal or monetary policy that would propel gold to higher levels. But now we don't have to go through that conversation with investors. They understand what the stage is, what the challenges are. They're looking for more. How do I invest in precious metals? What can I expect from it?
Yep.
So
Excellent.
it's a different conversation.
Yeah, big time. Just coming back to one of your points around the price, do you think there's a psychological barrier, the sort of $2,000 mark that needs to kind of push through, and then maybe that would also help reflect better in the equities as well?
Right. I think so. And I can't give you a scientific argument why 2000 is important, but I think we all have
nice round
milestones
figure.
in our life.
Yep.
Or, throughout, that we think about a certain level and then go beyond that. So
yeah, okay.
It seems to be.
Coille, just as the other portfolio manager on the panel, can I get your views on this? And how do you see things unfolding in terms of psychological barriers or some of the trajectory that we've heard around price, and then how that relates back down to the mining corporates?
I think I would agree with most of Doug's points. I think Q1 2023 was the strongest gold price on average. It averaged 1985. So I think that's a good point. I don't think people really appreciate central bank buying as a retail shareholder yet, and the importance of that, and potentially why they're doing that in terms of the impact that they're clearly, the signal they're shifting away from USD. It's last year was the strongest year of central bank buying. 2020, this Q was again the strongest Q1. It's interesting that Singapore is the largest buyer. To me, that's an interesting.
What does that signify?
Well, Singapore is, it's a business
hub.
It doesn't necessarily need to diversify from USD, and yet here they are. They increased their holdings by 50% in 4 months. I mean, that's a statement to me that's worth considering a little bit.
Yep.
I think to Doug's point about de-dollarization and sort of breaking up the supply chains, I think that's going to have a negative impact on the USD, which historically has been a strong case for gold. And I also don't think retail investors have had to consider the impact of inflation on their portfolios in a very long time. So there are a few factors there which I think are beneficial to the actual gold price. And then, but what has not worked is the mining equities. I mean, it doesn't matter which way you cut it. The operating margin that we should be seeing, it's not really flowing through yet.
Yeah.
From the highs in 2011, I mean, the gold price is up 7% and the GDX is down 50%. That tells you something.
If you're producing gold at this price, though, the business model's got to be good, right? This is a great price to be producing at. But then the OPEX and the other inflationary pressures on the business, is that what's kind of like making things sort of less attractive maybe for investors or investor sentiment in these equities?
There's very little liquidity in our space. You're seeing majors, from my perspective, getting bigger to stay relevant. I think the Newmont-Newcrest merger is an example of that, to stay relevant in the S&P 500 and wanting to be bigger. You are seeing more. I mean, the COVID costs, which we saw, and those costs have now been relabeled and are just embedded in built into the cost structure. I don't see those coming out. You're seeing a little pressure coming off in fuel and a few other items, but labor seems pretty sticky. I don't really see big step down in margin pressure, which means the gold price really needs to go up to get some margin expansion.
Yep. Okay. Interesting. We'll delve into that a bit more, but Kimberly, let me bring you in and get the view from the operator, the mine explorer and builder. And, aside from this good gold price and the trajectory, what are some of the real challenges at the moment?
Yeah, I think the perspective on the ground when you're running a junior mine company is quite different. I will say that if the central banks, the buying they're doing right now, it doesn't make any sense to not have gold in your portfolio. I mean, I don't pretend to know more than them. So I think it's something that is a responsible thing to do, to have a diversification with your portfolio. That being said, with running a junior mining company, it does affect access to cash. And let's be just frank with this. We are the risk takers. We are drilling blind holes, and the mid tiers and the majors are waiting for us to de-risk projects, and then they buy us out for a discount or a little bit of premium, but they're still using paper most of the time. So, that's a discount to me. It's not hard dollars. But we take approach at Lahontan of the long play. We are fortunate to have access to cash because of our partners and working in Nevada, Tier 1 jurisdiction. So I do look at it more of a 5-year plan. I think when people say gold has come off, I mean, if you look historically for the past 10, 20 years, gold's doing really well. And I do agree with Doug in that this whole 2000 mark is some emotional thing that is in people's minds. But again, our project still with 1 gram rock in Nevada is considered high grade. We can mine it with $1,000 cash costs and still be printing money. So for us on the ground, I agree with you in saying that the COVID inflation is not going away. Gas prices are not coming down. Those things are all there. So when you're thinking about fast tracking a mine and production, all those things have to play into your numbers to make sure you can make money at the end of the day.
Yep. And what about people coming to you, knocking on your door? If you're nearing production and we've got the central bank buying, there's not enough gold in the world. A conversation is easier. Are you having more of a variety of investor? Okay, we know there's not as much liquidity in the space, but given your project's progressing well, does that suddenly make you the standout?
Yes, for us it is, because our projects, our Santa Fe asset is a mine under closure. It's a past producer. We are being very aggressive to fast track this because I do believe as a CEO in a junior mine company, you need to make measurable difference on the ground and couple that with getting your information out there to the public. And yes, a major may come take us over, but at the end of the day, I've built 3 mines. The whole board has built mines. We can build it, whether we're around long enough to do that. At the end of the day, my job is to make money for our shareholders, and that's what we stay focused on. But we do something different at our company. We're drilling aggressively. We put out a resource that 1.7 million ounces, 1 million of that is an oxide. We have a clear path to building this, and we're doing our baseline studies so we can do that by next year, make a production decision. And this company's been public for less than a year, or just at a year now. So again, I just think that if you're a junior mine company, we have a little different perspective in that there's a lot of risk. If you really want to stand out, you really have to do your job and make sure you're fiscally responsible, using the dollars in the ground to make sure you're, being successful.
Yep. I don't know if you caught any of this morning's presentation, but Mr. Goodman at Dundee was saying an issue with this sector was, providing that technical due diligence and the inaccuracy across the board of sort of juniors, and that being an issue for him as a sort of fund allocator. Do you find is that a challenge? Is that something you guys have been comfortable doing quite a lot of?
We're really comfortable because I personally, with my business partner, have a private company of 5 mining companies. So we have an extensive team. They work across the board. We're always hiring people in all the jurisdictions we work in. So their job is to make sure I don't miss. And my job is just to buy projects and make it successful. So I feel really comfortable with that. For example, drill rigs, we have one on the ground right now. We have another one coming next month. I was in a bind and I said, can I have a drill rig next week? And they moved me to the front of the line. So having access to teams across the board is extremely important. And that's what we have. So we're lucky.
Yep. Great. Doug, could I come to you and talk about some of the perhaps investment triggers when you're looking at your portfolio and how you look at the tiers of junior mining up to the majors and how you look to allocate within that across your portfolio? Just talk about some of the strategy there.
Sure. Well, I think one has to start with a business model, and each investment opportunity obviously is unique. So you need to. What we do is we look at the business model and try to determine what are some of the levers or opportunities for them to create value? And to that, and then we're looking at the strategy of the company. What is their approach? Are they explorers? Are they trying to permit, develop? Are they financing? To try to put them in the context of their evolution. And certainly the asset is important. Is it an underground asset, an open pit asset? Where is the asset located? What's required to make the value daylight for investors? And then perhaps as importantly, perhaps most importantly, is the financial position valuation of a company. Do they have a capital access? Do they have sponsorship? And through the years, I've come to observe that sponsorship becomes really, really important, whether it's access to the capital markets or a particular investor base that has a significant exposure. Does management own a lot of their own stocks? If you do have good sponsorship, you can carry out your project and profile and carry out your business model and execute your strategy. So the financial perspective becomes really important. As far as allocating in the portfolio across the industry's business models, just roughly speaking, for us, it seems appropriate to have about 15% in the explorer, whatever you want to define as explorer. Explorers are sometimes considered pre-MRE mineral resource estimates. I would include a little bit bigger base that maybe it's a company with a mineral resource estimate, but also likely to expand that resource. They're maybe not quite at the feasibility stage. A company with a feasibility study and permitting is certainly a developer. We have maybe 25% of our exposure in that type of company, maybe a little bit more. The categories get a little bit blurred because some companies are developing, they're producing, they're exploring, they're doing all three. And you have to understand that business model. Where is the level of the value created? Is it in the discovery or the development, de-risking, or in the cash flows they generate? And then 40-50%, maybe I'm not quite at 100% yet, but that would be the producers.
Yep.
And then maybe half of that would be the larger cap names, and the other half would be a mid-cap group that has aspirations to be larger and maybe be acquired or what have you.
Yep.
So a little bit exposure to across the spectrum, emphasizing cash flow, de-emphasizing those that are consuming capital, but recognizing capital sponsorship is really important.
Yeah, interesting. And has that geared up on the sort of the 15% pre-MRE and the 25% since we last had you speaking here, perhaps sort of pre-pandemic, actually, I think? Is the exposure to the exploration end become more important?
I would say the exposure to the exploration side has probably become a little bit less because there's fewer opportunities, the way I would perceive them, in the marketplace. And I'm qualifying that by saying opportunities because I think it's become much more challenging in the world, not just to discover the geology, but to develop it in a region that is going to allow you to realize value. So geopolitical risk is increased. So I think West Africa is a great place to explore, but to commit capital, one has to think a few times about Western Africa and parts of Latin America, other Asia as well. So.
Yep. Okay, excellent. Coille, could you take us through your sort of portfolio strategy at the moment, and how sort of within the junior sphere, where are you seeing that value or value creation?
I think Equinox has historically always been very vocal about the importance of management teams. I mean, this is a very capital-intensive business, and backing management teams that understand not breaking your cap structure and not drilling excessively and being thoughtful about how they're allocating, exploration budgets, et cetera, is very important in the space. And similarly at the production level, I'd say early this year, we made the decision to double down on smaller cap names. We still have, so should back up. Our fund is very concentrated. We run about 25, 30 names total. So each name weighting is important. We've sort of probably a different view. All of us have made trips to West Africa in the last 3 months, reasonably comfortable there. Yes, there's headline risk. However, the cash flows are still coming out of the countries. Production hasn't been disrupted.
What are the headline risks though? Sort of like regime change, governmental pivots.
Sure. I mean, there was
like that. Think about
the first time I was flying to
Mali
Burkina, there was a coup, and so
Yeah.
I turned around.
Yeah.
And then I went back the next month.
Yeah.
I did. That's just, to me, that's part of the game. And so we were, I like the valuations in West Africa. I mean, these guys are producing probably the lowest cost ASICs globally because they're newer mines and higher gold grades on average. So that's positive. Yes, it's headline risk. Absolutely, something could happen. So far,
you have some of that in your portfolio, and
yes,
that sort of spreads.
Yep.
Yeah, of course.
And then just exploration projects or development projects. Given the higher cost of capital, that's sort of we've seen in the last, I'd say, 2 years. Development projects have had a hard time sourcing capital, understanding the devaluation differences between producers, developers, and exploration costs. There seem to be emerging between the exploration costs and the developers, and seeing opportunities there and sort of picking your spots in terms of where you can see catalysts and where you think you're going to make money.
Yep.
So I think that's how we've done it.
Yep, excellent. Just on the jurisdictional risk, what's everyone's sort of view on safe haven jurisdictions? Nevada, obviously, always gets great rankings, but is there benefits in sort of diversifying multi assets across the globe? I guess it depends on the state of the business, etc. But just trying to hone in on like what, if there's a definition on sort of jurisdictional risk. Not really. It's just got to be sort of case by case, right? It's got to be.
Well, if you look where exploration dollars are going, there's a clear trend towards quote unquote safe haven. Like the drilling dollars have gone down in Mexico and Latin America, and they've gone up in North America. So I think by definition, that suggests that people are trying to drill more in safe jurisdictions. And I don't think it's just safe jurisdictions in terms of like political risk. It's also the ability to permit in those countries.
Labor stuff.
Many things. It's in terms of being a safe place, quote unquote, where there's a rule of law. If you submit your permits, you're going to get an answer in 90 days, et cetera, et cetera. It's not just,
Kimberly, would you like to talk up Nevada at this moment?
I mean, it's just not black and white. It's all about your comfort zone as you're investing. I co-invest with my children on stuff all the time for fun, which crypto is one of them. I'm so not comfortable with that, and I've lost so much money just being a nice mother investing with him. So it's kind of the same thing in that there's a lot of amazing places where there's massive mineralization, like Africa. I've spent a lot of time working in Latin America. When I see all the political stuff going on in Peru, it just makes me laugh because it's just like, oh, this is like a soap opera. Like, I think I've gone through 7 presidents since I've been working there in the past 12 years. Or I can't even keep count. It doesn't move the needle for me in that, I'm not going to work there anymore. If you have the access to the team that really understand how to get something done, then, I'm not a portfolio manager, but I do know that when I'm looking at de-risking things, you have to understand what you're working with and what you're comfortable with. Yes, I mean, working in Nevada right now, I'm not going to lie, it's been super fun. There's no people. There's a very small town that they didn't believe in COVID, made fun of us for wearing a mask in the middle of COVID. I was mapping and sampling to get the hell out of the house. So, no, I mean, Nevada's great. The permitting process is straightforward. The BLM wants to help you. So yeah, of course, Nevada is a dream place. But again, when you're talking about jurisdictions that people may not think is safe, therein lies opportunities as far as investing. And even on the ground, as far as getting projects, we've gotten absolutely mind-blowing assets for very low cost, because everybody's scared of Peru right now. It's like, okay, give me that asset, I'll take it from you. So I mean, it's all about your comfort level. But I always believe that as an investor, you need to invest what your comfort level is, or you will lose money.
Yep, certainly. Okay, I want to touch on M&A now, just get the panel's view on where we're at in that sort of cycle as well. Sort of the view this morning was that, it's cheaper now to sort of acquire than it is to sort of build and develop certain projects. So I just wondered, Doug, where you thought we were at with M&A now. Do you want to see more of it perhaps? Or do you think as a shareholder of some of the larger producing firms, they need to start looking at putting dollars back into exploration? What's the trends here and what's the sentiment?
Well, I think putting more dollars into exploration would be wise for them. That takes a long time to play out and to be productive. And those are probably the best, most profitable ounces that you can add to your balance sheet. With regard to M&A, that's very much part of the business model for this sector. These companies deplete their asset. They have to replace their asset. Exploration is a way to replace it, but that takes time. Obviously, M&A, there's a lot of opportunities in M&A. I would like to see more M&A at the smaller cap level. I think that would benefit the industry significantly. It's great to see the big headline Newcrest and Newmont, merge, but it's hard to get some value from that as an investor. That value, I think, comes over time, but I think for investors in this space, there's perhaps a little bit more immediate joy when you see the smaller companies come together and, add value by the combination, add recognition, add significance to their market cap, and share the risk. I think it makes a more exciting story for investors. So many of the smaller companies do have just one asset. So it's perhaps not as dynamic of a story as you might get with a combination of two or three small companies.
Yep. Interesting. Coille, do you have thoughts on M&A at the moment? You want to see some consolidation?
I would agree. I think the average mine life now is sitting in single digits for the first time. The average grade has gone from 2.5 down to 1.5. I mean, it's by definition, to keep your production profile flat, you're going to need to do M&A just to keep going. I think in the fragmentation in the gold market, just even at the production level, it's too high. Like if you compare it to the copper space, top 10 copper is 40% and top 10 in gold space is 25%. There's just too many, to me, there's too many companies fighting over too few assets, capital. So I think if you could consolidate, it also would allow some things that maybe should just die to, to have, it would focus investors' attentions on potentially assets that have the ability to make it through a cycle and go into production.
Yep. Okay.
So I would agree. I think we definitely need more consolidation. We need management teams to decide that they're willing to part ways with an asset for the benefit of shareholders.
And Kimberly, is the junior operator, what would you say to a large producer coming knocking on your door?
This is actually my biggest pet peeve of the junior space, in that there's too many of us. We're all fighting for the same capital dollars. Even in Nevada, it's ridiculous how many stories are out there and small resources. I used to work for Warton, and unfortunately, we bought up most of Nevada, and so a lot of those companies, the share structure is not ideal. It's just the structure in general for these companies are not what I would take on as a consolidator. My favorite game is Monopoly, so if I could consume all the properties in Nevada, I would. But that's the problem, right? Like, you have a lot of companies that think that they're worthy of running a junior company with one asset that really isn't going anywhere. So, yeah, the consolidation needs to happen, but it kind of gets screwed up with so many of these stories that are stagnant. For us, we have prospectors that work for us full time looking for assets. And we just picked up a project that's 15 kilometers away that I don't know why my neighbor didn't do it, but we got it for 1.8 million, 7-year deal, back and loaded. And the whole risk this year is $10,000 to own it. And it's a massive land package. It's all oxide. It's a satellite literally to our flagship asset. So there are many opportunities out there for M&A and grabbing up assets if you're really looking. But again, consolidation does need to happen, but there's a lot of management teams that really love their salary. I'm really about making money for the shareholders and either building it or selling it. I don't care. It's just about making money on the ground for the team and for my investors like you guys that want to throw in risk dollars for us. So couldn't agree more with both of you guys' statements.
Excellent. Look, there's a couple of minutes left. Does anyone have any questions for our panel? For our panelists up here at the moment? No? No one with any burning questions on the points?
Nope.
No, I want to come back to just to round up on the de-dollarization question, because it was quite interesting. It sort of came around this morning as well. What does it spell for the gold business? You know, in that sense, you know, it's a positive in a way, but then we're here in the States. You know, we're sort of trading and exchanging and investing with dollars. So what does the dynamic do? And what's your sort of view on this trend gathering pace? You know, the BRICS countries having a meeting quite recently. I think they were. Obviously, that's going to be part of the agenda there. How's it going to play into the dynamic that we've got now, where the world is increasingly dividing its sort of trade routes and geopolitically it's dividing? Anyone want to take that broad theme?
Yeah. Well, you know, I think it's an interesting development in our world. Our world has changed so much. We all recognize that this decade. And I think one of the things I would be pointing to is that countries have recognized the value of their resources in a different way. In the past, they were trying to attract capital to develop it for jobs and community development. But now countries are using it in a different way. They're recognizing they have natural resources that they can use to make a political statement to the world, that certainly they can use for economic development, but they want control of that messaging, that economic prospect. So, you know, countries are grabbing more royalties and taxes, ownership, and they're making the world recognize that if you want to come and develop our resources, you have to pay for it. You have to, we have to benefit first and foremost. That, I think, is a different development than we saw maybe 10 years ago or even 5 years ago. And I think that will continue. We're seeing it certainly in Africa, in Latin America. It's kind of interesting. I guess Chile is trying to develop its own lithium resources. And you just wonder if that's really the best, given they are or were a major copper producer, if we really want to allow Chile to be solely responsible for the development of their own resources. I mean, how can we stop that? I mean, it's their resources, but will that be efficient for the rest of the world's economies? So
Yep.
It's a question.
Indeed. Yep.
I think that just sort of creates an environment where you're going to have more and more inefficiencies in terms of supply chains. I mean, I think resource nationalism is something that is going to continue. I mean, within 5 years, I mean, the Congo is now almost the second largest producer of copper, which is, and it came from relatively, low base. So that can change in many industries very quickly if there's enough capital behind it. So I can see how that could, in some ways it's good for us because it creates more projects that are probably less optimal, but if they're in the right jurisdiction, then there's maybe they attract some capital.
Excellent. Okay. Well, unless there's any other... there's a gentleman with a question in the back.
The equities of land and metals, so as frustrated gold sector equity investor, can we expect that our only catalyst is higher gold prices?
Well, Mike, I hate to say yes, but yes, I think that's it, because we've had so many other catalysts, whether it's other M&A transactions.
I think, In other sectors, things will be round.
Right, right. So I think you've got the answer. We need higher prices. I think above 2,000 for a period of time will get people to wake up. The margins on profits on that on a $2,000 price are pretty stout. So
I guess so not having to ping pong a gold price with every Fed utterance probably
yes, yeah. I think for long-term investors, that's the important element. Long-term, there's so much noise near term, and that's where the opportunity is, but that's not where the payout is. The investment opportunity is near term, the payout is long term, and that faith is something you just have to have and live with and stick with it.
Yep. So new incentive pricing for gold to bring the generalists back in, and then we've got our liquidity, and then we can go again. Yeah.
Hey, a big discovery might do it too. A super discovery in Nevada.
Yeah.
So,
yeah.
Kimberly,
I've got
go
it.
ahead. Right. In the end, Cisco gets carried kind of for their value creation, and maybe that's the opportunity, and you think of it that way.
Okay. Oh, yeah, gentleman here.
Just following up from your question, so do you see a slackening off or falling off in the investment in fact brick countries moving towards some kind of alternative to gold? I mean, it remains to be seen whether that'll happen. There's a lot of talk about it. But do you see the perception that it might happen?
Perception that there'll be a decreased use of the USD in.
As a trade currency. Yeah.
The perception, because perception might be greater than reality.
Sure.
If it continues as we keep hearing about it, do you foresee a lessening, a diminishing of investments from North America in particular, in countries such as West Africa, Lithium Triangle, and those current areas that have momentum?
Crystal ball.
I don't actually think so. I think because most investments are done by private companies or publicly listed companies as opposed to nationalized investments. I don't see, BHP changing where it's going to make investments.
What about Sprott?
As far as changing our perspective and because of geopolitical risk?
Not changing your perspective, but making fewer investments or pulling back because of perception of threat.
Yes, pulling back. I mean, Burkina Faso, I think, is a great country to find gold and operate it if you have the logistics. But there's a lot of risk there, and it's not the government. It's the jihad that's infiltrating the country. That's something beyond kind of an assessment that you can have as an investor, because that's so unknown. You can kind of anticipate, hey, maybe the government's going to turn over every 3 years or 2 years or whatever it is.
What about the unrest now in Sudan, which is pretty chaotic there in the last month? Do you see that?
But it doesn't encourage you to bring your money to Sudan.
No, but does it affect any activities in that part of Africa?
Yeah, it slows them down. Perseus is there, and my understanding is they've slowed everything down. And to what end, I'm not sure. They're waiting for clearance, which might not be a year, 2 years, 3 years from now. They have a great asset. So,
Because it may go on for some time.
yep,
It's not like there's a resolution anytime soon.
right. So that makes one pull back and say, hey, where can I have a safe return? We don't like to wake up on a Monday morning and realize that our asset was taken over, right? So, and it seems more of a potential outcome in this day and age than where we were 5 or 10 years ago. So yes, we are kind of pulling back. I think, roughly speaking, maybe 70% of our portfolio is North American, being Mexico, U.S., and Canada. Whereas maybe 10 or 15 years ago, it was more like maybe 55 or 60% was in North America. The rest was in the rest of the world. So we have migrated more to North America.
Okay, well, there you have it. Yeah, interesting times, good prices, lots of work to be done. Anyway, thanks very much to the panelists.
Thank you, folks.